Hey, good morning, everybody, and welcome to another Mortgage Coach webinar. Today's focus is going to be on compliance with Mitch Kider. My name is Dave Savage. I'm the CEO of Mortgage Coach, and if you're on this call, you're a client, you're a friend of mine. Connect with me on LinkedIn, Facebook, and hopefully you've downloaded the Mortgage Coach apps. So, our mission and what we're totally dedicated to is just helping every borrower make a confident mortgage decision and one that aligns around their financial goals in a manner that they actually understand. I grabbed this slide from Nikki Groff, one of our clients with Wallach and Volk. Her and I've been helping her create her compliance training for her sales force, and this is a slide that she came up with, and I think it just does a nice job of setting the table that, TRID is complex. There's a lot of moving parts, and we're here to make it simple. But when you really break it down, the goals are pretty simple from the CFPB's perspective. They want to improve accuracy, transparency, and consumer understanding. So, this is what it's all about. So, great to have Mitch Kider on today's call to answer some questions, to bring some clarity to everybody. Welcome to the call, Mitch.
Thank you. It's good to be here with you guys.
Yeah, well, thanks for the time you took to prepare. You're always a consummate professional. We forward you some questions that we get from our clients and from our executives. You do a great job of putting them in a great order and helping us prep for today's call. So we appreciate that, man.
I appreciate your comments.
Good. So as my co-host today, we have Joe Puthur, the president of Mortgage Coach. And Joe, I know you wanted to open it up with some updates on new features within Mortgage Coach that we put together from a TRID prep standpoint, and then we'll
absolutely. Well, again, everyone, welcome to today's call, and certainly, Mitch, thanks for being here, and to all of the hundreds of folks in the Mortgage Coach community, thanks for you being here as well. And remember, within the GoToMeeting, please enter your questions throughout the event. We always take these questions back, and they help shape our future conversations that we're going to have here in these sessions. As all Mortgage Coach subscribers here on the line know, mobile and the ability to do more with your Mortgage Coach subscription on the mobile device is a very key focus. And one of the most important things through a lot of these changes that's apparent is that we have to improve and help you improve your ability to proactively communicate with your consumers and with your partners. So from the mobile device now, you can record and you can update your video narrations from all of your presentations. It's really important to note how this changes the paradigm. Again, you do not any longer have to go to your desktop or record video from a web camera. You can now select the individual, either the partner or the consumer, pick them, identify the presentation, and record the video. And so when you're thinking about a current conversation, whether it's during the marketing process or a pre-GFE conversation or throughout the loan conversation itself, even during changes in circumstance or post-closing, updating that video is a very easy way of ensuring that your communications are reaching both the borrower and everyone else who needs to hear some of that information. So you can do that from the phone now as well. Now, it's also important to realize that from the phone you can take control of the presentation. So what you click on when you highlight a graph or a chart, or when you highlight a particular fact or figure or fee, the mobile phone as well as any device that your customer is looking at. So even if mom's on her web browser and dad's on an iPad and you and your wife or you and your partner are on your device, everyone is going to see that information at the very same time. And you can do that from your mobile phone. So when you're alerted that someone's viewing your presentation at 7:30 at night, proactively reach out and take control of the presentation. If you need any help at all utilizing any of those new features, please reach out to support@mortgagecoach.com. But you'll notice inside your Mortgage Coach app, there's a person icon in the corner. Click it, use your Mortgage Coach login, and you have access to all these features. So very, very exciting, and again, thanks for all the folks on the line making thousands of hours of video every month to help families understand and make a confident decision. So Dave, I think that's the most important product update.
No doubt. When you look at TRID, it's raising the bar on how we communicate with the family, with the realtor, and we keep them all in the loop. So great job to the Mortgage Coach product team. So Mitch, let's kick things off. There's been big news over the past few weeks. But now that TRID, has been delayed to October, do you have any advice for the head of marketing, head of production? Any thoughts come to mind?
Well, I do, in fact. And let's start with lenders in general, if I may. My advice to the companies that are out there is that you use your extra time wisely. Make sure you use your time to get it right on day one. With the delay in the effective dates, I think it's probably fair to say that the CFPB is not likely to be quite as lenient in their examination and enforcement as they would have been starting on August 1st. I think the attitude will probably be, well, you now have an extra 2 months that's available for you to get it right. So don't let up. Make sure you get it right. And there are really two keys that go along with that. It's education and it's preparation. Those are the two things. Companies need to, in fact, make sure that their employees are trained, and you need to test your systems to make sure that, in fact, you're prepared. You have to have those policies, procedures, and practices that are appropriate for compliance with this rule. You have to have them in place. And this rule impacts a lot of different policies and procedures. Your policy as to what constitutes an application, how one takes an application, when you have an application for purposes of, in fact, submitting or giving out the disclosures, the loan estimate itself. You have to have good policies and procedures about the pre-application procedures, so you know what the prohibitions are, what things you cannot do pre-application and what things you can't do. You obviously have to make sure that you have good training in place for the disclosures for your loan officers and others, so your loan officers know how to explain all of these things. And finally, it's a good opportunity to go over what your vendors have been doing for you. You cannot simply rely on the vendors. Your compliance people need to be able to identify if the vendor has gotten something wrong and need to address it. And it also gives you, as a lender, some time to, in fact, come up with a backup plan for when systems, don't work, because there will be some failures, there will be some issues along the lines, and you're not going to stop the production. You're going to have to give these disclosures out. So have a backup plan for those particular cases. Now, the two things specifically that you just asked me is what would I tell someone in marketing and what would I tell someone in production? Well, here's the way I look at this. Marketing itself creates consumer expectations, and production, those are the guys that have to manage the consumer expectations and that have to meet the consumer expectations. So there's a little bit different things going on over there. If you're in marketing, don't tell someone, don't market a product that says you're going to close in 1 week, because when this new rule comes out, that is simply not going to happen. You're not going to be able to get that done. So you need to work together. You need to understand this rule, and you need to work with production and the company as a whole to make sure what it is you can say and what it is you ought not be saying. Because, as I said, if you're marketing, you're setting expectations over there, and you don't want to set expectations that your production people cannot, in fact, meet.
So Mitch, I got a lot of questions from heads of production, and this one I think actually came in from Sarah Middleton with Fairway. But from a loan officer perspective, because let's face it, a lot of the folks on this call are mortgage professionals. They're going to be talking to the families. What are just 3 things they could do with their extra time to prepare?
Well, 3 really important things they need to do is, number 1, educate themselves. They need to educate themselves as to what the rule says, what it does, what the requirements are that will be placed upon them. And along those lines, in that education process, they need to learn the forms themselves. See what's on those forms, see what your company's going to have you put into the forms, because ultimately you're going to have to explain these things to the consumer. You're going to have to know it inside out so you can explain it to the borrower and they can understand exactly what your transaction that you're proposing is in fact going to look at. So that's number 1, educate yourself as to the rule and as to the forms themselves and what's contained in them. Number 2, educate yourself as to the nuances of your particular company. Take a look at your company's policies and procedures. Make sure they're there, make sure they're in place. If they're not, insist that your company have policies and procedures for you to follow along those lines. But make sure you know and understand what your role is in the company itself. Are they going to have centralized disclosures? Are you going to be handling the disclosures yourself? What are the policies and procedures, and what is it that you're supposed to reflect and represent about the company and about these disclosures to your customers, to the real estate agents you deal with, and to others along those particular lines. And so I guess the third point comes right from that. Make sure you ask questions. Don't just sit back and expect that it's coming to you. Everyone is still continuing to try to figure this out in your business, in your industry. So ask the questions that you have. Go wherever you have to go to make sure you get your questions answered. So on day one, the expectations that you have on yourself and others have on you is going to be met on that day. So those are the three things. Educate, take a look at the policies and procedures, and ask the questions.
So I have two more to add for every mortgage coach on this call. There's no reason to wait, making sure every family gets that total cost analysis. You could show the cost over 5 years. That's a conversation you're going to need to have. And as a mortgage coach, everybody in the industry is going to be showing the cost over 5 years. You can show with Mortgage Coach the cost over what's relevant to the client. So to Mitch's point, ask the question, how long do you plan to be in the home? If it's 3 years, you can show the cost of the loan over 3 years pre-LE. So make sure you're tailoring that to the client. And then we all know that communication is, there's going to be more touch points. There's going to be more conversations. So start making sure that you're adding a video to that total cost analysis so the borrower's in the loop, the realtor's in the loop, and you're more efficient and you're more effective with the way that you communicate. So thanks, Mitch. That was great. Joe, you're up.
So a lot of the leadership folks on the call, obviously from the lender perspective, some mistakes are going to be made. So when you think about that, what are the best things that we can do? What are some of the cures to be aware of, or what are some of the things that are simply not curable?
Well, so here's the harsh reality of it all. The rule is a process-driven rule, and we've talked about that before. And a lot of the rule centers around timing. When you give the LE, what waiting period you have on the closing disclosure, whether or not you have to have an additional waiting period because something else happened along those particular lines. The problem that you really have, the harsh reality is, there's really no clear way to cure a timing mistake, okay? You get the timing wrong, there really isn't a cure for it. So first and foremost, creditors have to ensure that they're limiting these particular mistakes. They should be very few and very far between. The LE has to go out within 3 general business days after 6 pieces of information have in fact been collected. That's what the LE has to do. The CD has to be in the hands of the consumer, of the borrower, at least 3 specific business days before you can go ahead and consummate that transaction, before you can go ahead and close. That's what's important. You're still going to have to manage the expectations from the outset, especially with regard to the timing of the closings themselves. Now, there's some real liability out there. There's no cure for a timing error. No cure at all. I mean, what are you going to do if you didn't get it out within 3 general business days? The answer is you're still going to get it out. But are you subject to liability? You are subject to liability. I mean, there are statutory damages because they put this under the Truth in Lending Act. So there's statutory damages of $4,000 per violation itself. There's also the ability to get actual damages and attorney's fees and things like that, but we really need not talk about that. The point of the matter is that's how important these timing requirements are, and that's how important the substantive requirements as to what you're stating in your loan estimate and what you're doing by way of tolerances. Now, there's a built-in cure into the system itself. You are disclosing certain things in your LE, certain fees, costs, expenses, and if you're not within tolerance, you're going to cure it. At the time of closing, it's going to be calculated up, and then you're going to have to do that particular cure. That's okay. That's not going to lead you to any other liability as long as you follow those cure procedures correctly. But the bottom line is, don't go out there and do things like, well, I missed the 3rd day on the disclosure, so I'm going to cancel this loan application and initiate a new loan application. You actually cannot do something like that. You cannot deny someone because you missed that deadline. You need to move forward, and you need to just deal with the situation that you otherwise face. The bottom line with all of these things, when you're talking about mistakes being made and cures and problems and issues that you may run into, It's all from your regulator's perspective, from the CFPB's perspective. It's all going to come down to whether or not you had an effective compliance management system. That's what the CFPB is going to be concerned about. Have you been actively managing your compliance with the laws? Were you proactive in monitoring the problems that address these particular issues? You found a problem, are you proactive? Did you take corrective measures to make sure that it never happens again? Did you find it quickly before it became a systemic problem itself? If you do those things, you're much less likely to face some of the penalties that you can have for these bad disclosures and for timing errors and things along those particular lines. Because remember, there are 3 tranches of civil money penalties that the CFPB can impose: $5,000, $25,000, and $1 million, depending upon whether you did this unwillingly and unknowingly, or whether you were reckless, or whether in fact you, in their eyes, willingly knew that you should not have done something but went ahead and did it otherwise. So it's all going to come down to the compliance management system. And when you ask me what it is that someone should do about these mistakes, well, really now's the time to put everything into place to avoid the mistakes themselves. Will there be errors? There absolutely will be. But should they be very, very few, especially with this new extension of time? Yeah, there should be few. Update your compliance management system. There are 8 things that I can think of that you need to do in updating that particular system. You have to have provisions that ensure that your senior management is closely involved in the oversight of TRID, especially up front, especially in the beginning, so they can jump in and take the actions that are necessary if something goes wrong. You've got to develop those TRID policies and procedures, manuals and employee guides. You've got to educate these guys. You got to make any necessary changes to your business processes. Remember, you now have a definition of an application that may be just a little different than the one you were using in the past itself. And for example, if you're a wholesaler and you're dealing with a broker, if you want to be doing these disclosures yourself and not have the broker do it, because you will be bound to the broker's disclosures, you're going to have to change your business processes to make sure that you get that information really, really quickly. You got to form, internally, you have to have the expertise by way of committee members. You have to have mandatory training, obviously. You got to monitor, especially up front, all the time. You may be able to pull back a little bit, but you're always going to have to monitor compliance. And corrective actions, we talked about that. That's absolutely, absolutely essential. And finally, I will say that you should include a TRID compliance in an independent audit as well. You should have an independent audit taken of your TRID compliance to make sure that, in fact, you're doing this properly.
Well, that's very insightful, and I think that when you think about all 8 of those steps to take, they are all encompassing of the business processes from cradle to grave of what happens every day for folks who are out there selling the loan. And I think the most important thing, as you stated, is to use this extra time to really prepare everyone that's affected by the change within the organization for what the expectations are. And while there's of course your originators and your internal processes, there's also your partners. And for many of the folks on the line, they're purchase-focused business. They've made the pivot. We know where the market is headed. So what additional focus or attention would you put on how TRID's impacting the pre-approval process? And most importantly, what kind of expectations to realistically set for the realtors that are out there?
Well, let's talk about the pre-approval process first, and let's talk about them both, and the expectations for the realtors that are out there. So the CFPB has stated that TRID should not affect pre-approvals if you're talking about a pre-approval where you don't have all 6 pieces of information. The type of pre-approval where you might have all of the information except for a property address itself. And CFPB has been on record, and they actually state this in the preamble of their rule as well, that TRID should not impact that pre-approval process. That should be the same as it always was. The issue that you run into is that you cannot prior to giving the loan estimate, you cannot, in fact, require that the consumer give you verifying information. Now, there's an argument there that says, well, in a pre-approval where you don't have a complete application, if you're asking them to give you verifying information itself, you're not doing it for an application, you're doing it for a pre-approval, and that might be okay. That's one way of looking at it. Another thing is just make it clear that it's voluntary. I can help you with a pre-approval process, but in order to do that, you have to voluntarily give me this other information itself. You can explain to them the bind that you're in, because otherwise there's going to be a loan estimate. I have to wait till I have a full application, give you the loan estimate before I can require that you give me this information. And the CFPB has talked about that. People from the CFPB at various conferences and at webcasts they put on, and they talk about getting that information, in fact, voluntarily. Now, there's another kind of pre-approval that lenders talk about, and that's a pre-approval when you already have all 6 pieces of information itself. And that's a little different, because this rule is absolutely going to impact that. Because when you have all 6 pieces of information, you, in fact, have a requirement to go out there within 3 general business days and send out the loan estimate. That's your requirement. You might want to argue that I have these 6 pieces of information, but it wasn't submitted to me for purposes of getting an extension of credit. But I don't think that argument really is going to go anywhere, because I think if in fact someone's asking you for a pre-approval, that is almost one and the same as asking you for an extension of credit. It's just one step earlier because they need that letter in order to finish up something or to finish up on their transaction itself. So, you know, my approach to this is to be careful. I think pre-approvals are fine. I think that you can do it. I think you have to get information, that verifying information, voluntarily from the consumer. And you can't tell the consumer that they have to, in fact, get a pre-approval in order to make an application with you. You can't do that. The reality is they can go forward and just make an application itself when they have all 6 pieces of information available. So the rule itself, okay, that you can't ask for verifying information before the disclosures are made, that actually isn't different than what exists today. That exists today in terms of you can't ask for verifying information prior to the GFE being made. It's just not a lot of people focus on that, and not a lot of people have abided by that particular rule necessarily. But let me give you some examples so that everyone understands what the CFPB is talking about. What the CFPB says, and these are their examples, they say that when you're obtaining an application, the creditor can ask for the sales price and the address of the property, for example. But you cannot require that the consumer provide a purchase and sale agreement to support that information itself. That's number one. Could you do a pre-approval without the purchase and sale agreement to support the information? Sure, you could. You're going to condition it upon getting that verifying information at a later point in time, but you can still go ahead and do a pre-approval under those circumstances, or you can tell them they can voluntarily bring this to you, but they don't have to. Another example that the CFPB put out there is a mortgage broker may ask for the names, you know, and the account numbers and the balances of your checking account, you know, a consumer's checking account or savings account itself, but they can't. Prior to that loan estimate going out, they cannot require the consumer to provide the actual bank statements or similar documentation. Does that affect your ability to issue a pre-approval? Not necessarily, because I still think you condition it upon getting that verifying information, upon that information being accurate itself. But if you don't want to do a pre-approval without that information, then simply tell them they can voluntarily give it to you, or they can wait until they make application and they get a loan estimate.
So when you explain the process, obviously a bit is the semantics of how we approach the conversation, and that delicacy of what's required versus what they can volunteer. To the realtor on the outside, if we were to really boil it down for the originator on what to set their expectations, because they're only seeing the bylines of TRID, right? They're on the peripheral. So what would you kind of give as the cliff notes to share with the realtors themselves?
Well, in terms of the realtors themselves, they need to, as a loan officer, as a mortgage lender, as a company, you've got to do a really good job in customer relations, both with realtors and others and with the consumers themselves. Very, very important that you in fact do that. So what would I say to the realtors about TRID? I would tell the realtors about the time guidelines that exist, first and foremost. I would let the realtors know and understand that once an LE has been given out, the consumer has a minimum. It's whatever I set in my LE, but it has to be a minimum of 10 days before they have to tell me whether or not they intend to proceed. And so during that 10-day period, that impacts our ability to go quickly through this particular process if in fact we haven't heard back from them, because we can't charge fees. I would absolutely let realtors understand under this particular rule that I can't ask for verifying information. So there's certain things I cannot do in my underwriting process, okay, if the consumer does not give me this information voluntarily. That is going to impact timelines. By necessity, that's going to impact timelines, and they need to know that. Now, many realtors today in many hot markets, they will not take a consumer around unless they have a pre-approval. Some home builders will not, in fact, sign a contract with you unless they have a pre-approval. These partners to the mortgage banking and mortgage lending industry, they need to understand the restrictions that you have up front prior to disclosure of information. So they have to understand what problems may arise along those particular lines and the fact that you can't force them to give you that particular verifying information. But most importantly from the real estate agent's perspective, it really comes down to what happens at closing. And what happens at closing is you have 3 specific business days that consumer has to have their closing disclosure in their hands. And it's got to be right. And you can't have certain changes that may cause another additional 3 waiting day period, because if you do, and we'll talk about that later, you will in fact have to wait an additional 3 days for that. And so the real estate agent needs to know that. They need to understand that. You've got to manage them. You've got to manage and help them manage their customer, your borrower as well. Very important. The relationships that you have with your realtors are going to be closer. There's going to be even more contact, and good loan officers have a lot of contact anyway, but there's going to be even more contact. I think you need to keep them informed all along the process in terms of timing so they can, in fact, manage their own and their customers' expectations as well.
So Mitch, I mean, given all the conversations that you're having with lenders, I mean, what do you think is causing the most confusion or the most concerns based off all the dialogue that you're having out there in the market?
So, I mean, there are a lot of concerns that are out there. There are concerns as to, having a sufficient amount of time to, test what LOS providers are giving them and getting the documentation correct and filling out the forms itself. But let's just set that aside because that will get worked out through the process itself. One of the biggest concerns I see is people are very nervous about that 3 specific closing day, 3 specific business day period that they have to wait before closing itself. So many lenders are contemplating providing that closing disclosure prior, even earlier than 3 specific business days before closing. And there's a lot of confusion as to what that means in particular. Once you give a closing disclosure, you can no longer provide a loan estimate. So if in fact you're giving a closing disclosure 10 days in advance and you have a changed circumstance 2 days later, you have a problem on your hands. That's going to be a cost that, in fact, the lender is going to incur, because you cannot give a loan estimate again under those particular circumstances, and chances are really good that, in fact, you're going to be out of tolerance, and you're going to have to cure it along those lines. There is one limited exception. If there's less than 4 specific business days between consummation and the time a revised LE would be required to be provided to reset the tolerances, then in fact you can do it by changing the closing disclosure. So that really just comes down to changes that occur 7 business days prior to closing, because your notice could have arrived there 4 business days before. That's really what it comes down to. But the earlier you give the closing disclosure, the more you are at risk to incur certain costs if there are changes, because you can no longer handle that with a revised LE itself. So there's a balance that needs to be done along those particular lines. And there's a lot of confusion in the industry about that. When I tell people that, most of the time they don't realize that sometimes giving that disclosure really early will impact that and will cost them money. Others that come to understand that particular point are, you know, for the most part willing to take that particular risk, in all honesty, because they don't want to hold up the closing. So it's more important to them on the whole to get this done on a timely basis, and the closing proceeds as it otherwise should proceed. Now, there are some nuanced questions that has created a lot of confusion. I told you about the limited exception for changes that occur just before closing, and that's okay. You can treat the closing disclosure as a loan estimate. In other words, you can change it in the closing disclosure itself because it was a very late change right at the end of the transaction itself. But what happens when there is something that changed that causes you to, in fact, have to add on an additional 3-day waiting period? Can you still do that, or are you now out of time because you've already given the closing disclosure? It's a complicated issue. It's a problem. You would hope that the CFPB would come forward and clarify some of these scenarios that make it very tricky and that the industry is wrestling with. The CFPB for some time now has been hands-off and not issuing any changes or new guidance to the industry because, you know, not for a bad reason. They're doing it because they want the industry to implement the rule without interruption. But now that the effective date has in fact been delayed, you know, I'm hoping that the CFPB will address some of these other issues. You know, what you do when in fact there's an additional 3-day waiting period. When can you still make changes and reset the tolerances? Things along those particular lines. In the meantime, absent anything that's coming from the CFPB, creditors really have to check with their investors and see what their investors' policies are, and because obviously, you know, you have to meet their requirements as well. Otherwise, you're not going to have a source to sell your loan to. I think that a conservative reading of the rule and a consumer-friendly approach is the best option right now. I would not be too aggressive, quite frankly.
That makes a lot of sense. I'm seeing a lot of questions come in. Some of them, I think, are questions that Mitch has already answered. And I do want to remind everybody we are recording this. And every time we interview Mitch, we put that in our YouTube page. And we also break down some of these questions one by one. So I urge you to re-listen to the recording. So Mitch, you know, we really want to help loan officers deliver more value to realtors. And I think when we look about what can a loan officer do pre-TRID, I mean, obviously the total cost at the point of sale, using video more effectively, but what are, you know, the 3 to 4 simple data points that loan officers should utilize to coach their realtors on TRID and how to best navigate it on the contract side of things?
Well, so first of all, we did talk about managing the expectations of the real estate agent. And I find that to be the most important thing that you have to do. And they need to clearly understand that they should not be scheduling closings, and you should not be scheduling closings on the last day of a buyer's lease, because there are certain things that can in fact happen at the very end that may hold up that closing. And a closing disclosure may be given a little bit late, and you still have to wait for those 3 specific business days, or something else may have happened where you have an additional waiting period on top of that. So the answer to your question is, first and foremost, you've got to keep them informed along the process the entire way, and you should be talking to them now and answering any questions that they may otherwise have. You also should recognize it's important for you to do this as well, because the buck stops with the lender. Virtually all of the liability for what happens in TRID goes to the creditor and no one else itself. I mean, the settlement agent, the closing agent, has some liability to the seller on the closing disclosure, but that's all that it is. So in terms of data points, when I think of data points, I think of, number one, first, it's the LE, it's given, and I think we need to have a good understanding of the intent to proceed, what that requirement is, what the implications are, what we can and what we can't do during that period of time before we have an intent to proceed, and your real estate agent needs to know and understand the implications on timeline for the transaction, depending on how the consumer reacts to that and how quickly they give you an intent to proceed itself. Number two, we talked about as well, in terms of a data point, they need to know about 3 specific days for the consumer to have that closing disclosure before you can consummate that loan and you can't close. And so they need to understand that, because there's no real waiver for that. The only waiver that's there is in a dire financial consequence, and the only one that the CFPB can come up with is that that consumer is being foreclosed upon. And the truth of the matter is, it's not a very good example, because if it's being foreclosed upon, I'm not quite clear why you're closing on a new loan with them. So, I don't think you're going to get much out of that. The third data point is understanding what things will require an additional 3-day waiting period. If certain things change, you're going to have to wait another 3 days. And realtors are all about selling their homes and getting it done quickly and getting to that particular closing. When they do their contracts, they need to put TRID-friendly provisions in there. In other words, understandings between themselves and the consumers that there are certain things that are not within their control that may delay a closing, including the timing of disclosures that otherwise are coming from the lenders and things along those particular lines. So, you want to have the consumer obviously be bound to cooperate with whatever lender they choose, to move forward as expeditiously as possible, but continuing to give them the time and the space that's mandated by this particular statute and this particular rule. And you can work language out in your contracts along those particular lines. You want that borrower to know and understand contractually that in fact closings may be held up in certain instances, and still they are bound to go forward with their particular closings when in fact all of the relevant timelines are met. Really important for the realtors to understand it, for them to educate their own customers on it as well, and to deal with it contractually. It's no longer a period of you're closing on this date, period, and that's it. And if you don't close on this date, something else may your sales contracts that mandate a specific date for closing, and if you don't meet it, hold you in default or something else, really need to be adjusted and changed.
Yeah, no doubt about it. It sounds like it's time for a couple good strategic meetings with your realtor. I interviewed Nikki Groff with Wallach & Volk on last week's Mortgage Coach call, and did a little update with her today with Ken Perry. And she was talking about how she's meeting with her realtors, how she's showing them the process, and again, that leadership is just bringing confidence to the conversation. So make sure you're having great meetings with your realtors and you're bringing this all to bear. So Mitch, getting into the. Oh, Joe, did you want to say something?
No, absolutely, no, it's fine, Dave.
Okay. Oh, Joe, it's your question. Sorry about that.
Either way, at the end of the day, you've answered this question a few different ways as far as, when the 3-day clock starts and ends. But, in our Q&A here, there's a lot of fringe questions. Things like if it's sent electronically, does the 3 days start when the borrower opens it versus the sent date? If you FedEx it and the delivery date is based on the sign-off, or, what are some of those nuances? I don't know if you can speak to that.
Well, I can. I mean, it's all subject to the mailbox rule. So unless you're handing it to this consumer, unless you're putting it in their particular hand, if you send it electronically, if you FedEx it, if you do any of those particular things, you have a mailbox rule that is applicable to you. And that means there's an assumption that that consumer receives that 3 business days after you put it in the mail, after you put it on your computer, after you sent it over to them. That is the bottom line. You can, in fact, if you have receipts, if you're following the e-sign act when you're doing it from a computerized, if you have receipts otherwise from the FedEx perspective and they sign for it, you can use other evidence to show receipt itself. That's what you can do. But if you don't have evidence of receipt and you haven't placed it in their hands, then the mailbox rule is going to kick in and you're going to have 3 business days that's going to be added on top of that. You're going to assume that they received it 3 business days later.
Sure. And I think, for those of you who are asking this question in our Q&A, we'll make sure to direct you to the recording. Obviously, thanks, Mitch, for addressing it in a few different ways. I also think it's important to ask, obviously the borrower is trying to understand their options throughout the loan process. Our solution, as well as other processes that people have within their lending platforms, involve pre-disclosures and having conversations during that process. And so what would you say are some of the rules of thumb of what can be provided and what's important for some of the heads of compliance and heads of production that are listening into this call to know?
So that's a really good question, because this is an area where there are some prohibitions on pre-disclosure activity, on certain activities themselves, but also a recognition that, in fact, pre-disclosure activity can be helpful to the consumer and can help this consumer shop around and look for the right loan product for themselves. So basically it comes down to this. Your loan estimate is your loan estimate, is your official formal loan estimate, and one which, by all accounts, you're going to be bound by within the tolerance levels that are set by this particular rule. And in most instances, those tolerance levels are very, very, very tight. In many instances, there's 0 tolerance for change from the loan estimate to what you ultimately charged. But that doesn't mean that pre-disclosure, you cannot still talk to your consumer. You cannot still, in fact, give your consumer some type of an estimate of what their fees, costs, rate might otherwise be. The rule that is in place now with TRID is actually similar to a rule that's in place today in terms of providing a written estimate of the terms or the costs that are specific to the consumer before he receives the loan estimate. The cost estimate that you give them cannot look like the loan estimate, cannot look like the closing disclosure, has to have different headings on it, and must in fact be on different forms. They can't be forms that make the consumer believe that this is their formal loan estimate. You also, on these forms, have to have a specific disclaimer, and it has to be in a specific font. It has to be in 12-point font, and it's got to be at the top of the page of any estimate, pre-disclosure estimate that you may give. And it has to say your actual rate, payment, and costs could be higher. Get an official loan estimate before choosing a loan. Now that disclaimer is a new requirement. The industry hasn't seen that before, but you have to have that out there. So a lot of questions that come in is, well, what about general advertisements when I'm advertising rates and things of that sort? And the answer to that is no, you don't need to have that disclaimer on your general advertisements. This disclaimer goes to estimates that are specific to the consumer themselves. I mean, ultimately what we have over here, Joe, is the CFPB wants to ensure that these cost estimates, which sometimes are just unreliable, the information changes, it's just not based on the best of information that the loan officer may have. The CFPB wants to make sure that they are clearly distinguishable from the loan estimate, which, as you know, has a good faith requirement, and that is the difference that we have over here. One of the bottom lines that I will say to you about this is no one should use worksheets or estimates as a way to really sell to the consumer and then go ahead and change the terms when you're on the LE. In other words, if you do one of these cost estimates, which I think is healthy because I think it helps the consumer get prepared and enables them to look around as well to see what else is out there, but you have to do your very best job to get it as close as you possibly can to what is correct. There are going to be practices out there where people are going to use cost estimates, and routinely the loan estimate that's then given to the consumer is going to be different across the board. Not everyone's going to do that, and my point is no one should do that. In fact, they should work very hard to, in fact, get it right and create something that will enable the borrower to look back and say, okay, from day one, I was dealt with fairly. Because otherwise, you're going to have a UDAB issue on your hands. So make sure it's on a different form. Make sure it has a different heading. Make sure you have the disclaimer in there. Make sure you tell them that they should go ahead through the transaction, get a loan estimate to really know and understand what it is, but have a good faith effort at getting those pre-disclosure estimates correct or as close as you possibly can to where they need to be.
So, go ahead, Joe.
Mitch, again, thanks. I think the clarity is very clear on what needs to happen in the pre-disclosure now. For those of you who are Mortgage Coach members who are on the line, I think one of the things that really needs to be emphasized here is making sure you have all your templates set up, making sure all of the settings are all consistent. And so for many of you who are the admins who are listening into this call, make sure to reach out to support@mortgagecoach.com if you haven't set up your templates, making sure that everything is consistent as been talked about. With that being said, I think, Dave, you have some questions around TIP.
Yeah, I do. I think, one thing I want to do before we do that is we're bringing some leadership to a lot of our clients, and a lot of Mortgage Coach clients, they're looking at their sales process and they're saying, how can I make sure that I'm informing the client along the way? And obviously the disclosure's really clear. As Mitch said, you can have that solution outside of the disclosures, and that's something that we have obviously spent a lot of time at Mortgage Coach, is helping you deliver that total cost analysis before it's in escrow so that the family can make an informed decision. When it's put in escrow, maybe they want to look between points, no points, single premium MI versus monthly MI. And again, there's changes. So what you're seeing with the Mortgage Coach community is you're seeing Mortgage Coach have more touch points along the way to help from before the LE, pre-LE conversation, and continue to update the information in Mortgage Coach just to keep the family in the loop. And then the thing that's nice about this for all you mortgage coaches, if you sent the link, the things that are relevant to the realtor, you can update that TCA, you can update the video, and when it's appropriate, have the realtor in the loop. So more important than ever that you fine-tune your sales process and you fine-tune your touch points so that you're accurate, so that it's consistent, and so that the family understands their options. Anything you want to add to that, Mitch, before we hit this not last question, but this next question?
No, I think your advice is the right advice. I think you've got it exactly right.
Okay, great. So Mitch, what is the reasoning and the purpose behind TIP, and the total cost over 5 years. I mean, those are things that some loan officers are not entirely excited about quoting to families, but what's the why behind that?
All right, so the current TILA disclosure focus on the cost of credit based on the loan's contractual term, so generally a 30-year term or a 15-year term itself. But consumers, we know, don't generally hold their mortgages to term. They either sell, they move, they refinance, they do a combination of things along those particular lines. And the CFPB believes that a more accurate reflection of what the cost of a loan is going to be is one that, in fact, reflects, a 5-year period of time. Because they found that most people will either sell or refinance in a 5 to 7 year period of time. And so the loan estimate is going to require that you put this, total cost and total interest percentage into your loan estimate, so the consumer can really take that and shop around, and they can do an apples-to-apples comparison with other lenders that are out there and see exactly what this really is going to cost them if, in fact, they believe they're only going to be there for a 5-year period of time. And in all honesty, that makes a lot of sense. Now, the closing disclosure itself is going to, talk about life of the loan, which is fine. But it's upfront that the CFPB is more concerned about, and that is they want an educated consumer. And an educated consumer needs to understand what they're really paying for this money for that 5-year period of time that they're going to keep this loan. That's the intent of it. It makes a lot of sense. A lot of people have agreed with that, have asked for that for quite some time now. It is, it's very different than what's required under Truth in Lending today, but simply telling people in your upfront estimate what the cost of their loan is, over a 30-year period of time really doesn't give them very useful information.
Totally agree. Cost over 5 years makes tons of sense to us at Mortgage Coach. And again, remind everybody, whatever the relevant time is for the family to make an informed decision that aligns around their goals, provide that also.
I think it's interesting, sometimes the smallest changes create the biggest waves among originators. One of the things that's come up a lot is, just this change that fees need to be in a different order. It seems like many folks have memorized the way they lay things out and just review it as second nature. Any insight on why alphabetical over other grouping?
Well, yeah, I mean, the CFPB has spoken to this particular issue, and even in their regs, they talk to it a little bit. They studied this, they say, and they found that, it's consistent listing of the costs in both the LE and the CD in an alphabetical order, they say they found, will facilitate the consumer's comparison of what was disclosed to them up front and what they ultimately paid, what's disclosed to them on the closing disclosure. And that's going to help them with a better understanding of the transaction itself. Now, they elicited comments on this during the comment period of the rulemaking, and many came back and said, well, why not do it the way we've done it before on the GFE and on the HUD-1 settlement statement, and have hard coding along those lines. And what the CFPB came back and said was that they found that descriptions of settlement services really vary from jurisdiction to jurisdiction, and sometimes they even vary from creditor to creditor. And so simply having hard-coded numbers or lines that you put it in, you may get different names and different descriptions that ultimately go along with that, which makes it very difficult for the consumer to really match up those particular fees. And the CFPB believed that, if they were going to continue on along that route, that they would actually have to step in the process and define every service in the residential transaction and require a specific description for it. And they chose not to do that. They didn't want to step in the process along those lines, so they leave it to lenders. And you call it what you call it, but you do it consistently, you do it alphabetically, and your consumer is able to take, one document, their LE, another document, their CD, and it's pretty easy to match it up. And listing it alphabetically, they thought through consumer testing, showed them that in fact that was the best way to get that done. The reality is, I will tell you, it's changes like this that people look at and they say why, and some of these things can be frustrating. But if you just take a step back, and you look at the end product and you match the disclosures up, they're pretty good disclosures. From a consumer's perspective, which is the only perspective that the CFPB is looking at it, it is easier to look at and see what your fees are. It is easier to go ahead and match those things up. Now, the CFPB managed to make this rule, completely, unduly complicated. They really didn't have to do it. They have different definitions for business days. They have so many different timelines. They created a large jigsaw puzzle itself. But in terms of the forms themselves, when you look at them, they're not too bad. They're not too bad. They should have simplified the processes all around those forms, and we'd be in good shape.
Sure. So, but it is fair to say that lender to lender, now that they're not standardized titles, that it could be different, depending as the customer is comparing different things. So that change in terminology, it means they're only really lining up to that particular loan estimate and closing disclosure.
Well, I think that's right. For some reason they think otherwise, but I think you're right. But that's no different than what we have right now too, because lenders call different things anyway. So we already have that particular problem itself. And at least the consumer can take their form if they chose to do it. I mean, the reality is most consumers don't take these forms and shop around. That's just the truth of the matter. And even the CFPB's own study said, even under these forms, they don't think that they're going to shop around a whole lot. It just doesn't happen that way. But if they took their LE to someone else, they take a look at the list and they say, I have this particular fee. Let me look at yours. What is this fee? Is this a comparable fee? What am I matching it up to?
Sure. So, we know also that there's a lot of encouragement in terms of the type of messaging, switching back our topic a bit to marketing and generating business. When they're talking about providing education or providing that type of responsibility in messaging to the customer, what do you really think they're referencing? What onus are they actually putting on the lender to teach the consumer?
Well, they're putting the onus on the lender to do exactly what you said, to teach the consumer, to make sure that the consumer knows and understands their transaction, knows and understands exactly what they're getting into, knows and understands what questions they should otherwise ask. And they are putting that burden on the lender to educate the consumer, even those consumers that don't ask a lot of questions. The CFPB wants you to look at, what might be your least sophisticated consumer, and if they don't know what questions to ask, you tell them, so they fully jump into their transaction, as the CFPB says, knowing what they're going to owe. But their real focus on marketing is coming around this new home loan toolkit. Recently the CFPB released this home loan toolkit, which has taken the place of the special information booklet once TRID goes into effect. And the toolkit, is designed to explain what the loan estimate is. It's designed to explain what the closing disclosure is, and it explains how those documents interact with the home purchase transaction itself. It also provides questions that the consumer should ask of lenders and of themselves when they're looking around for a mortgage and they're shopping around for a mortgage itself. And in the last webinar that the CFPB put on TRID, they explained that what they really want is all market participants to really use this toolkit, not just lenders that are required to hand out this toolkit, within 3 business days, or to basically put it in the mail within 3 business days of the of getting those 6 pieces of information, of getting the application. But what the CFPB said was they think it's a good toolkit. They think it will educate the consumer, and they ask that all industry participants, real estate agents, title, escrow, mortgage professionals, they ask that they provide this toolkit to the consumer as early in the home buying process as possible, even before an LE or something else goes out, because they believe that, in fact, this will go a long way to helping that consumer in the very early steps of their transaction in making the important decisions that they have to make. And so from a marketing perspective, they're adding a provision. They published instructions recently of how companies can put their logo on this toolkit as well and use the toolkit itself as a source of marketing for their own company as well. That's really what they're pushing. And if you take a look at the toolkit, it's those things. It's what should the consumer know, what should the consumer ask, both of themselves and of you, and things along those particular lines. And yes, they want lenders to go beyond that as well and help educate the consumers. But the whole marketing pitch that you're hearing about really does focus around that toolkit.
Beautiful. So all you mortgage coach leaders that are on the call, we are absolutely dedicated to that. When you're showing the cost of loan over 5 years, you're showing TIP. Let's face it, from a loan officer's perspective, these are new data points. Some loan officers aren't going to be confident, and when you think about how you're delivering that to the family, on a PDF, on a fee worksheet, we want to help you do that in a more graphical way, graphs and charts. We want to make sure that you can present the cost over 5 years, or if it's a family that wants to evaluate the cost over 7 years, over 3 years, whatever's tailored and relevant for the family, to be able to deliver that to the family and to make sure that the realtor's in the loop. And of course, communication is going to be king. So you need to be able to attach a video or an audio message and be able to narrate, here are your options, whether it's mobile, whether they're looking on a desktop. And again, every mortgage coach on this call, I think you need to recognize that you're going to need to be more accurate with that information up front. It's one of the reasons why we're so excited about our partnership with Optimal Blue, the ability to go from price to advice with the click of a button in Optimal Blue. And you're going to need to get better at creating and updating those audios while you're on the go. And that's why Joe and the product team created the ability to create a video on your mobile device. So please come to more of our educational events. Every Tuesday at 9 o'clock, we're interviewing authors, we're interviewing speakers, we're interviewing top producers, head of production, folks to help you get better. And every single day, we are providing training. Right now, it is just critical that you improve your habits, you improve the way you quote rates, the way you talk to consumers. So if you're new to Mortgage Coach, we've got our basic training at 8 o'clock Pacific, and we have our advanced training at 2. So every day there's training. So as we wrap this up, Mitch, is there any last words, any feedback you want to give to the Mortgage Coach community of professionals and leaders?
Well, I will end it where I started. You now have an additional 2 months before this rule. Well, you don't have it yet. The CFPB is proposing this change, but my guess is that you will, in fact, have it. Use your time very wisely. Come out of the blocks in October and give yourself a competitive advantage by knowing and understanding this particular rule, what needs to be done, get it right from the beginning, and you will be in the right place.
Beautiful. So folks, please let us know what you thought of today's call on a scale of good to great. Also, if you're new to Mortgage Coach or you're a guest and you want to get a demo of our product, click on the last option. Joe Puthur, any final words from you as we wrap up today's call?
No, I just thank everyone who participates in our community. Thank Mitch for attending, and for all of you who are leading so many families and realtors to make confident mortgage decisions. Keep up the great work. Thanks so much, everybody.
Thank you, everybody. Thanks for being here.
Guys. Thank you. Bye-bye.